So this analysis is of three different pieces of legislation in different jurisdictions on how to separate investment bank from retail banking. Europe is actually the last. Volcker rule is in the US, the Vickers reform has been in the UK, and the EU-wide reform, which is about to be adopted tomorrow, is the last in this line. This is a piece of legislation that is a bit different than previous pieces of legislation. So it's not just raising capital requirements or enhancing supervision. It's actually meant to provide a structural reform, as the title already says, i.e. having different legal entities doing different things within the bank or ring-fencing certain activities, which means that it really goes to the core of how banks are organized. The reform is actually meant to address financial instability and the too big to fail. So it is meant to address those institutions that are so big that they could undermine the whole economy.
What about the issues about transatlantic convergence? I mean, there are different philosophical approaches, and of course we've got the context of TTIP.
That is a difficult question because indeed it seems that the philosophical approach, as you mentioned, is different in the EU than in the US. In the US it seems to be meant to address the attitude of bankers and the morality of their actions, whereas in the EU it's much more focused on trying to minimize the cost of bailouts. For me it's hard to see how this would apply the same way or how you can get convergence in these rules. It is difficult to see how this proposal would tie in with the growth agenda, where there's a shared objective of entities in Europe, I think, to enhance non-bank financing, because banks are in a bit of a tough space right now.